All right. Hello, everybody. Welcome back to a market open for my stream. But for Jesse's stream, it is the PayPal Q1 earnings. And for Couch Investor Neil's stream, it is PayPal Q1 earnings as well. We are here on my channel, Jesse's channel, I believe a bunch of Twitter accounts and Neil's channel. So we're streaming everywhere because we got to tell everyone the news that PayPal is up 7% in the pre-markets. Jesse, let's start with you. What are your raw thoughts on the price action?
Man, I haven't went too far into the details of it. I'm very happy to see them beating pretty much across the board. I love that they're raising guidance for the year. I said like in the last conference call that's what I thought they were doing, and I was happy with it. I thought they were going to lowball. They needed to reset expectations after shocking the world by their shocking the world comment. And so I think they've executed perfectly on that. I'm very excited about the call today. I want to see what Alex, I'm hoping he goes into a decent amount of detail on how they're progressing with all the different initiatives that they have. So I'm stoked, man. I can't be angry about 7.4% with as many calls as I have.
Neil, your raw thoughts, then we'll get into the numbers.
Yeah, I mean, numbers look good, beat across the board. I think next quarter revenue growth was a slight miss, but not such a big deal. I like what I saw. There were some surprising numbers, which we're probably going to touch on a bit later on. But overall, yeah, we're on track. We're on track. There is still a lot of work to do to turn this whole thing around for 100%. But happy to see the numbers, happy to see the beat across the board. There are going to be some comparisons that are a bit weird because of the new non-GAAP metrics, which now include SBCs. But other than that, I think shareholders should be happy. Again, when the market opens during the call, things can get mentioned, then the stock gets down a bit. We've seen that with SoFi yesterday, green, then red, and then suddenly the sentiment changed. But as long as the business is doing well, we're happy. Well, it's up 8%. I've never seen that before.
Yeah,
for PayPal. What?
Yeah.
The only thing that makes me sad, real quick, Amit, is the fact that there's only 2% short interest versus float. So like that makes me sad. I wish it was like 20, like SoFi yesterday.
Like SoFi, yeah.
Yeah.
Okay, so let me start with this question, Jesse, and then we'll get into the numbers. So the stock's been beaten up for a long time. You and I got into this in May 2023. Neil, were you there that early, around that time?
My average is 57, so I don't know when that was, but...
So you got in closer to the bottom. So the stock, I think, bottomed around 55, stayed in a range for a while, and now it's breaking out. Given you're really good at technical analysis, understanding when breakouts happen, when things form a higher high, what is happening with the price action right now that's allowing it to do this? And how do you think the price action is going to revolve if the earnings call actually goes well?
Oh, it's going to be beautiful. I could actually show you.
Yes.
Let me see real quick here. So I haven't used this.
Well, while you're doing that, let me just read out the numbers for everybody. So revenue, we were expecting 6.6% year-over-year growth. We brought in 9% for PayPal. So that was a nice little beat on revenue at 7.7 billion versus 7.02 billion. Payments volume was supposed to be 394 billion. We brought in 403 billion. So that's up 14% year-over-year. Nice beat on that. And then EPS is a miss, but there's some particular accounting rules that doesn't really make it a miss. And they also bought $1.5 billion in stock, and they raised guidance. So all basically a triple, quadruple beat because payment volumes matter for them across the board, which is really good for PayPal. And that's why the stock is up right now.
All right. Now, whoa, this looks so weird. It's bouncing between like 7 and it went down to 0%. So somebody was unloading real quickly, waiting for a drop. But from a technical standpoint, and I don't know, Couch, you might have posted this too. So there's this market cycle chart that's out there, and you probably posted it as well. This is like the perfect representation of a market cycle where you start down at the bottom, you have this euphoric peak, and then you crash, and then it plays sideways for a while before eventually going back up again. So this has been a pain train for a long time, but one of the things I love right now, you can barely see it, but right up here, and let me do this. I got to adjust this a little bit. This works differently now. I've got a Mac, so I've literally given up on PCs when it comes to this shit.
I'm a Mac guy too now.
Oh my God. Now that I know how good it is, like I will not switch back, at least for YouTube stuff. Now here's what I like. So you can see where we had a higher high that just hasn't been happening for like 3 years, right? And now we're up here with our second higher high, second higher low. And from a technical standpoint, now we're above the first fib line. And we're looking like we're above the 100 moving average on the weekly time frame. And we've got pretty much air. So we've closed this gap over here, this daily gap. And not all of them have to close. It's like 10% of them. And with high beta assets, they don't always close. Like you'll have more of them open, right? And you're going to have them open usually at the bottom, not at the top, because when markets, like when stocks go up, right? Like they go up most of the time, unless you have a really shitty company. So the majority of the ones that don't close for the gaps are on the downside when it launches and it goes up a lot because they have a great earnings after really shitty expectations. But from a technical standpoint, we are already, and I said this yesterday in my post and in the market recap, but we're already hitting this $73 level right near it where we have peak volumes. So the question is, can we go past this? If we go past this and we establish support right here, because you can see this big chasm right here where there's just not a lot of volume. And all this does is it takes the volume on the bottom and it shows you the price range that it traded at. It's called the VRVP, visible range volume profile. And if we can get above that today, I would fucking love that. Or if we can just stay above the 100 and then set that up as a launch pad to get above this volume clip over here, then it's a pretty easy trip into the 80s. And
so what is the price that if we would close above today that would make you the most excited, and what's the price that would, if we at least close above it, you would be happy?
I mean, 140 would get me the most fucking excited, but I don't think it's likely, especially with 2% short interest. But I would honestly, man, if we could get above 73.50 and turn that into support today at the market close, that would be just an insane move that I would be stoked about. And from a technical standpoint, I mean, we're in a breakout zone. You can kind of say this is an inverse head and shoulder. You could kind of say this is a cup and handle, and we're breaking out of it. And the measured move just for that part, if we just go over here and we draw a little line, it's red. It's red because it's used to being red. But let me just click it over here. That would get us like, to $77 would be the measured move on a cup and handle pattern. So I think I just want to see it above 73.50.
Okay. All right. Not bad. That's some great technical analysis by Jesse, and hopefully 73.50 gets us there. So I guess let's talk about the fundamentals and what we're seeing right here. Neil, let's start off with you. What numbers out of these slides kind of stood out to you the most, and why do you think the street has it up 8% right now?
I think the street is happy with the numbers. I think when the report came out at first, it was red because of the changes that were not accounted for with regards to the inclusion of SBC. But then when they realized that, well, okay, the numbers are actually a bit across the board, then they were quite happy. I usually look at the metrics, transaction metrics, so transaction margin dollars, transaction margins. They were okay. Seems some improvements. Transaction margin overall is still down a bit, still low. But I'm seeing some improvements there with regards to the account activity as well. Active accounts is actually up quarter over quarter, still down 1% year over year.
How much is active accounts? Do you know what's the number?
427 million.
Okay, perfect.
It was 426. It kept on coming down, which fine. They said they're going after quality and not quantity. So, okay. But overall, transaction per active accounts is up 13%. Number of payment transactions is up 11%. So at least we're seeing some positive signs from that. Plus, I think this is a new metric. Maybe Jesse can correct me, but monthly active accounts. I don't think we were given that before. So some added information. I like that.
I think we did, but I don't know if it was highlighted at all. I think the way they're presenting stuff is a little bit better too. Right. And let me see here. I might have, I have a dashboard too that's a little more visual that you guys might like.
You got Alejandro.
It's from, Alejandro got it up. Yeah. So again, active customer account, it looks like 427 versus 426. Total payment volume, it looks like it's down a little bit. And let's go to the other metrics. These are the fun ones. And again, revenue segments, all this stuff looks good. Like the growth is all good. Let me see what estimates looks like over here. And again, look at the growth over here under, revenue estimates, EPS estimates. This is like, we're looking at EPS estimates that are as high as they've been.
Way. It's going the right way. Yep.
It's all going the right way. And then again, just looking over here, the take rate, what is that? 1.96, 1.76, 1.91, 1.74. Not loving that part.
Yeah, that's still down
a lot. I would like to see that get better. Monthly active accounts, again, like like Neil said, it's lower, but that's okay as long as transactions per active account, because you want people to utilize your product. If they're not utilizing it, you could have the number grow and
Correct.
still not have it actually fucking mean anything.
Correct.
It's actually costing you money.
Yeah, but it's all going in the right direction. And this is what I'm hoping for. I mean, this company got approval for over 10 billion. What was it? $12 billion in buybacks. And now they're talking about raising the pay or increasing the pace of buybacks. And they're raising guidance for the year. And so they set expectations stupid low. And now we're going to grind through them. And really, I mean, again, the thing I'm most excited about is to hear Alex on this call. He's finally got his moment. It's not a shock the world moment, but it's not a, we fucked up and said shock the world. But he set himself up perfect for this. So I think he's going to, unlike Anthony yesterday. Anthony did not seem confident. I think his play of trying to be, I don't know, it could be super smart for SoFi and Anthony Noto to be cautious the way he is being. If the economy takes a downturn, he's going to look like a fucking genius, and he's going to go on these calls and look like the next JP Morgan. But if we have a boom time, he's not going to be as confident. But I don't think Alex isn't going to have that problem this call. And that's what I'm excited about. I'm excited to see how he handles the call and if he takes a victory lap and shows us a bunch of cool shit.
So I'm reading right here, they returned $1.5 billion to stockholders by repurchasing 25 million shares. On a trailing 12-month, they bought $5.1 billion, which is 81 million shares. $5.1 billion is about 7% of the market cap right now. And they're authorized to buy more. So what impact do you think buybacks is going to have on the street psychology of the stock?
Fucking huge.
I think shares outstanding.
Oh, yeah. Sorry. Go now.
Yeah, shares outstanding are down. It's down 10% since 2021. So the longer it stays low, the more they can buy back. And I think that's great for us. And I think Wall Street loves that.
And I think they're going to be aggressive after this blackout window. I think they're going to be aggressive. If you look at Q2 of 2023, they had, what was it? 1.136 billion. Mm-hmm. And now they have 1.064. So it's just insane. The rate of buyback is insane for this company right now. And I can't wait. I think they're going to get really aggressive. I think they're going to get really aggressive because they have a short window to really get aggressive. So it's going to be very exciting to see what happens with this stock in the next couple of quarters. And I plan on making at least 6 figures today, maybe more. So it's going to be fun.
So how do we think about Alex Chris? I know you touched on it, Jesse, but last call didn't go the best. We saw Noto yesterday, which I also agree. I just think he felt he was uninspired. Fintech in general, not as have been having a rough year, but it's been getting a little bit of a rough rap. And if you're a fintech with a catalyst, maybe you can really capitalize on it, like we've seen companies like Robinhood do. What do you think Chris needs to do on this call to not fuck this up?
I think it's going to be really easy for him not to fuck it up because all the data is really great. And I think he knows that. Whereas before he was like the, bright-eyed and bushy-tailed CEO that just got this new company and was trying to prove himself, and he got a little over exuberant. I don't think there's very little that he could fuck this up with. And I actually think, so my take on the last one was way different. I think they deliberately fucked that up. They deliberately did that. Like Elon let, bears for Tesla take a victory lap for months, getting all excited that the company was fucking dying. And then he just announces news right and left about FSD. He saw that stuff months and quarters in advance because they have to work ahead of that. And so he knew he was destroying them. So I think that this is going to be fine. Alex Chris just needs to show us the progress. He needs to talk to the different elements of the business that they're working on expanding. He needs to talk about how they're creating efficiency. He needs to talk about, Fastlane and all these other cool things. And if he talks to those things and they don't deliberately sabotage the call, I think what was it? The CFO, that lady?
Yep.
She crushed the call last time. She was the doom bringer. And so, and it was deliberate. She wanted to lower expectations. So as long as she isn't the doom bringer today, I think we'll be all right.
Neil, how do you think this thing tanks as it opens? What has to go right for this not to tank?
If we get Alex Chris from last quarter and not from the recent conferences or the CFO from recent conferences, then I think it tanks. If there is no excitement, if they're again setting the bar extremely low just to set it low, I think that may be one of the reasons. But overall, I like to hear more about Braintree, like to hear more about transacting margin dollar, Fastlane, adoption rate there. overall, I mean, now they have the numbers to back it up. I know it's 1 quarter, but now they have the numbers to back it up, so he can be a bit more excited. Last quarter, he was still okay. I need to show you before you can trust me. So it was like maybe not that excited, but now, I mean, with this quarter plus what they've been telling us in the last month or two on conferences with analysts, I think it will be difficult to see this in the red. But then again, tomorrow Powell speaks, I think.
Yeah.
So I mean, he might be the one not helping us here, but we'll see.
I'm excited about Powell. We'll see how it goes.
I think people are expecting him to be hawkish, but I think he's going to say the same thing he's been saying. If he is going to raise rates, which I don't think is happening, it would happen way later because it would have to get so bad. I don't think it's that bad at all for him.
Yeah, well, and here's the thing. There's one thing that a lot of people miss in regard to Papa Powell and the Treasury. It's that we're paying an insane amount for our interest on our debt now. We were paying like 360 billion before the pandemic per year. Now we're paying over 900 billion, and we can't have rates remain high. It doesn't like they don't want inflation to run away. I don't think that's actually happening. I think China's exporting deflation to the world. And so that's not even an issue. And there's so many other countries around the world that are slowing down, and even our own, whether we like to prop up certain data points or not. When you look at jobs and you see that we've lost a bunch of full-time jobs and we've gained a bunch of part-time, I don't think that screams of hyper accelerating growth and that we're going to have to worry about inflation just going insane. But the Fed doesn't give a shit about any of that. They voice that because they want to suppress the markets, because they don't want them to run away and have a big bubble. But what they really have to care about is the level of interest on our debt, because it's going to be unserviceable. It's already bigger than our defense budget. It's bigger than Medicare. It's bigger than Medicaid. And it has to slow down. And it's the reason why the Fed is issuing short-dated treasuries, because they want to have really short-dated, no duration, form of finance for the government, so that they don't have to pay for this shit for 20 years. So like, I don't know. I think that Papa Powell has to go lower. He can't raise more. I think he's going to flip the same fucking way he flipped on inflation is transitory. When he told us that bullshit, and then it turned out to be a lie. I think he's going to do the exact same thing again, except in the other direction. I was thinking June we would lower rates, but I don't know. Maybe it's July, but I think it's got to happen at least once.
I think it's got to happen once. If they don't do it once, it feels like 2021, where they don't do anything around inflation, and I don't think he's going to let that happen again.
Agreed.
Yeah, as long as they're not reactionary,
they can't be.
They can't, because then it's horrible.
Then we're fucked. All of us.
Okay, let's talk exit strategy, because the stock's up 7%. A lot of people have options in this. Jesse, you've got $400,000 in options on this.
Yeah.
Your strikes are for 140. My strikes, I did a spread between 85 and 125. Obviously, the stock has underperformed where most people thought it would go. But given it's an option contract and given we have some time on the expiration, we can still sell it before theta decay really kicks in. So how are you thinking of exiting some of these options, and which ones are you thinking of holding for the long term?
Yeah. If you could pull up my screen real quick. So I actually have, I have PayPal calls that are January 17th, 2025, back from when I got excited about it in May of last year, because I was way too early. And I'm sad I even brought it up to people, because I think a lot of people have already jumped off the train for these because they just lost so much money, which is not like anytime I'm trying to show people things, I don't want them to lose money. So that's not my intent in any way. But so that sucks. When you're really early on options, that sucks. The 140 was much more attainable back then, because we had a lot more time, and we were actually higher, but maybe not anymore after today. But right now, these are getting long in the tooth. And so January 17th of 2025, that to some people that are like gamblers with options, that might seem like a ton of time, but we are so far away from that target right now. And you can't, it's not just that you want to get to 140, you want to get above it. Because there's a premium that you pay. There's this extrinsic value and an intrinsic value. In the end, you're only left with intrinsic. Before that, you've got extrinsic, which is just the premium on top of it. So you want, with options, you want things to move really right in the direction you want them to go in. And then if momentum slows, you want to get the fuck out. And so like these, I want to get the fuck out. So
it's a good learning lesson. It's a really good lesson for people, right?
Yeah, yeah. You want to get, so some people might think this is a ton of time, and they're going to be the ones that are filling my bags while I get the fuck out of this. And so they're going to be buying these things with 140 strike at a January 17th date, which is like, what is that? I don't even know how many, 8 months or something. It's not far enough. It's not far enough. And it can make this, but it would have to do it like a rocket ship. And I don't think that's what we're going to see. It's going to do well. We could go up a lot. So I'll sell these, and these will go up a shit ton today. They haven't moved yet. We'll be seeing that after the bell opens. I'm expecting maybe a $200,000 day. It could be close to that. Maybe it's 150, but I will dial out of these, and I'll dial out of them strategically. And I'll do it at each fib level on the fib, the trend-based fib extension. So I've established a bottom here, and each one of these different colored zones is kind of where I want to get the fuck out. I might sell a little bit today because I want to buy Bitcoin down like 4% on the day. So I might sell some of that. And you can see us on this chart. We backed off a little bit, and now we're hitting the 100 moving average. So we'll see what Alex says, but I might sell a little bit up into here. Won't be a lot. It'll be like maybe a 3%, worst case 5% allocation, all for the 2025s. I'll keep all my 2026s because I have a lower strike. I'm at 95 for that one. That one's just going to fucking print money for a long time. Right. That one I'm already up 30% on, 31%. And so, and I got 181,000. I've actually got some on another account. So I got about 220,000 in those calls. And that's before they really go up this morning. This hasn't really reflected that yet. So they will go up probably a lot. And I'll dial out along the way. And like I said, it'll be one of those things where did I just go with that? It'll be one of those things where each one of these fib levels. So I'll sell a little bit in the 70, 73 range, right around here, like I was talking about. And then I'll sell more around 82, and I'll sell more around 96, and I'll sell more around 113. And then ultimately I want to be 100% out of option plays around the 130 range when we get near the 200 moving average. I don't want to hold options anymore. Just like I did with Palantir. I made 600K. I got the fuck out. I actually don't even own the stock, I don't think, right now. I probably should at least have a share to track it on my balance. But I love the company. It's just not an asymmetric bet for me anymore. Right. When I get into options, it's because of incredibly oversold conditions over periods.
And that's what PayPal was. It was oversold when you got into it.
And it's beautiful. And so even today, I mean, I fucked up on this play. I fucked up just about as bad as you can fuck up on an options play, right? And yet I'm down 45%. 45% after thinking this was happening in May and having almost a year come around. Like, we're right fucking there, right? Yeah. So I fucked up on an options play for a year, and I'm still only down 45%. So that's what I'm talking about. That's why I like these asymmetric bets, because the upside potential for this is ridiculous. And yet my downside risk is just literally what I have in the contract, and I'm willing to lose that. And since I've been, tethering into the 2026s, those have a ton of time, and they won't have the dramatic theta decay. So right. I'm very excited. Very excited.
We got 9 minutes of the call. Thank you, everybody, for being here today. Let's talk a little bit about SoFi, and then we'll transition to the call. Neil, what were your thoughts on those earnings yesterday?
So overall, the quarter was fine, right? If we look at the numbers, it's up to the right. Call could maybe been a bit better. Anthony Noto was not that excited, but maybe he is now playing the Alex Chris of a Q4 game, lowering the bar, doesn't really want to put any pressure on the stock, which already has a ton of pressure. Q2 guidance was a bit weak-ish, so okay, there is that. But yeah, I think, since the start of the pandemic, since student loans have been basically canceled for them, the company has done quite well. I think they've navigated quite a lot of uncertainty, triple beats almost each and every quarter. So yeah, 1 week-ish call to me is okay, as long as the business is going up and to the right, as long as we're seeing profitability become better and better, margins are expanding, they're still on track for their 2026 goal. Not too bad, right? I've seen worse. I think I've seen worse. And yeah, if the stock doesn't reflect that in the short term, then I think long-term investors should enjoy should enjoy that, because eventually, if the business succeeds, I mean, long-term investors, I think, will do quite well. I don't know how the options game is with SoFi. Maybe Jesse can tell us a bit more about that. But yeah, overall,
Oh, sorry, go ahead.
No.
Oh, I was gonna say the option game sucks. This is another one I failed at. So got in too early.
Do you think you failed, or you think, because your strikes are what, $12, $15 in the year?
I'm down. What am I down? I'm down about the same amount that I am with PayPal. But now PayPal, I mean, I could be in the black by the end of the week on PayPal.
So do you think the 10% drop was warranted yesterday for SoFi?
Yeah, because he's being super conservative and it's a bank. So there's levels of risk there that are much higher than a regular investment, because banks have fractional reserve lending. And so they don't have the money. Banks don't have money. And so it's a very important thing to understand that basically any bank in the United States that isn't being confirmed as I will survive by the federal government could die. So there's just levels of risk with banking that are much greater. And I think Anthony Noto is being prudent. I think he wants to go balls to the walls, but he knows he can't. And he knows that there's too much risk and he needs to be conservative. And so I don't know how well that's going to play out with my calls over the next couple of quarters. I'm going to give it another one to see if, they improve, and they can go to dust. I've only got like 180,000 in them. So it was 400. But so they could go to dust. I don't care. But I wish I would have been. I haven't been buying aggressively into it like I've done with all these other things. And the reason was because of the banking related risks. So we'll see what happens.
I mean, sentiment can shift quite quickly, especially with the likes of SoFi.
And they're a great company. They're a great company. I mean, for a bank, they're a great company.
Jesse, it's below 7 though. Do you think it's oversold and that's an opportunity?
Fuck yeah, it's been oversold for a long time. I mean, if you look at it from a technical standpoint, I can show it just real quickly.
Yeah.
It's incredibly oversold. Let me see here. I got one of these so far.
Yeah, we'll do this one, then we'll talk Bitcoin for like 2 minutes, and then we'll do the call.
Yeah. So if you look here, there's this previous resistance level that we had broken out of, and then we tried to go back and find support. We didn't. We broke underneath of it. Then we tried to find support. We did. Then we tried to find support. We did. And now we've just been finding support, and the 100 moving average on the weekly time frames curling up. From a technical standpoint, this thing wants to get above peak volume and it wants to break out. We've got a downtrend that goes back to November of 2021. This fucker wants to go higher. It's just looking for a reason. So if we get something where the next quarter rates look like they might be coming down, or we've got an announcement about that, and it looks like the economy isn't going to fail and we're going to melt up before we melt down, this fucker will take off. That's my take. Sorry for all the vulgarity.
No. Yeah, if you can handle the vulgarity, you got to go somewhere else today.
For me.
Yeah, let's pull up Bitcoin. So 61K right now. What are your thoughts on that one? ETF flows are drying up a little bit. Do you think it's getting ready to run?
Yeah. So, I mean, we had the Hong Kong Bitcoin ETF and Ethereum ETF that came out last night. I've been saying for about a week plus maybe that we could still travel down here into the 59. Like we'll probably test under 60 again. And it looks like we're getting ready to do that. And so we got a bounce zone in like the 57 range. If we didn't get it there for some reason, it could go to 52, 53. I don't think that's likely, but I fucking hope it does. Because if PayPal takes off today and in the next couple of days, and then I think Tesla's retracing a little bit today, probably worries just about the Fed tomorrow. I think the whole market might be that way. But I would love for some of my stuff to take off and then be able to get more Bitcoin. That's like my ultimate dream. That gets me excited. So I hope it fucking drops like crazy. That's my buy.
Do you think the reason it's dropping is because of the Fed meeting and like Bitcoin itself is also a little scared of what Powell says, or
no? Well, I mean, kind of. People act like some people believe that Bitcoin just acts in a vacuum. It does not. It has to trade just like everything else. It trades 24/7. So if no other markets are open outside of a few small ones in Robinhood, then it can go up and down because people might need money. And so if all of a sudden something crazy happens and after hours, there's no other markets open, they might dump Bitcoin if they think they need to have money for something else. And so it can move with the markets. I mean, that's a true statement. I think that this is just the incredible run that we've had in Bitcoin from 15,000.
Right.
And then the halving event, again, it's going to get a lot better. It's going to go up a ton. There's a bunch of reasons why, but it needs a breather. Wouldn't be crazy. have a breather for months. Maybe it's possible.
All right, last 2 minutes. Neil, give me your quick thoughts on what's happening with Tesla, and then I'll get Jesse's thoughts.
Well,
15% in a day on some China news. You think it's fake or real?
Nah, I think we're retracing back. I mean, as much as I want this to continue to go up, I don't think 15% makes a lot of sense on a news of Elon visiting China plus the news with Tesla and BYD and FSD. I mean, maybe we're going to see a big earnings EPS boost thanks to that. But then again, when? I think just the full reversal sentiment shift from 140 before the earnings to now, I think we're going back a bit down. I don't know how much, but I don't think it holds up 15% on that news, because technically speaking, or fundamentally speaking, should I say, nothing really changed that much yet. Yes, it's one step in the right direction, but other than that, we're still waiting. Q1 was still a very bad quarter. So, yeah.
All right, Jesse, your quick thoughts?
Oh, I fucking love this company. You don't want to hear my shit. I'll talk too long, but he is right though. It's a huge move over a short period of time, but I think that the margins are going to be going exponential in the quarters ahead. And we could retrace a little bit. It's one of the reasons why I sold like, I don't know, 100K or something yesterday at it.
Yeah, I think it's really exciting. I think it's really funny that at 138 retail, people like you, Jesse, were saying, you got to buy this thing. And Wall Street was like, no, it's going to 125. And maybe Wall Street starts buying at 180, even if it goes back to 165, 170, maybe then it looks like a discount. So it's going to be interesting to see how that one plays out.
I was screaming in the 130s and people are like, you're a fucking idiot. And everybody in my comments was telling me I was a fucking idiot. So I knew I wasn't.
Yes. You got to go against the herd. You got to go against the herd. All right, guys, we're going to shut up. The call should be starting in probably 10 seconds. And let's see how they do and where the stock goes. $70.04 in the pre-market right now.
Cool. Ooh, employment data. Oh, employment costs came in hotter than expected.
Oh boy.
Dum dum dum. But it's quarter over quarter, so it's kind of to be expected if you know what's going on.
Yeah, S&P is down a little bit. SoFi is 692.
Yeah.
Tesla's down 3%. PayPal's still $70.
It says employment costs, benefits, wages, and the overall cost index. The cost index was supposed to come in at 0.9, and it came in at 1.2. Employment cost 0.9, it came in at 1.1, and benefits 0.7, and it came in at 1.1. But a lot of that, I think, was in the beginning of Q1. And so it's just like the other price data.
The thing about the music, dude, is like if the stock's up, the music's okay. If the stock's down, you just want to punch your screen when the music's there.
Will we get copyrighted because of their music?
No, it shouldn't. If we do, then it's whatever, but I don't think it would.
I know that's happened with a few of the others that I've been on. It's like, what the fuck? There's a copyright on this shitty music.
Elevator music.
Yeah, they literally make it from earnings calls. That's like all they get for revenue.
It's like if we were down 20% right now and you're listening to the music, it was pissed off.
Yeah. Like, turn this off.
Yeah, and there goes my revenue from my YouTube stream. It's like I lose it to this person.
They're late by 2 minutes because Chris is collecting his shares right now. He's counting his dollars.
Yeah, I think it's interesting too. We didn't even say it, but I mean, they switched to the morning for what I believe is the first time ever. That's kind of fascinating. I think he's going to do the run. He's going to do like the CNBC and all the others today, talking up the company. That's my guess. And maybe he's just a morning person and there's no fucking rationale whatsoever.
It could be like Noto yesterday.
Yeah. Noto should have had his coffee.
Did it? It started. I was listening on their site, or let me just reload it.
I don't know. Let me check.
Any obligation to update this information. And with that, let me turn the call over to Alex.
Thank you, Ryan. And thank you to everyone for joining us this morning. This quarter, we delivered a solid set of results, and the year is off to a good start. Our new leadership team is operating well together, and we are really starting to get our arms around the business. You will see in our numbers and the read-through that our efforts are beginning to make a difference. We also see substantial need for continued retooling of the company, how we work with our customers, and how we execute. We are encouraged by the progress to date, but remain realistic that we still have a lot of work to do and a lot of opportunity to drive profitable growth ahead of us. What we said at the start of the year still holds. This is a transition year where we are focused on execution and making critical choices that will set the business up for long-term success. We have a plan that will return this company to where it needs to be and remain focused on execution to get there. We see clear opportunities for operational improvements across our large enterprise, small business, and consumer businesses, including Venmo, and in driving more efficiency across the organization. But it will take time to prudently drive a meaningful and sustainable transformation. In the first quarter, we delivered 10% revenue growth on a currency-neutral basis on $404 billion in total payment volume. Transaction margin dollar performance grew 4%, which was better than expected, thanks in part to actions we took. Our non-GAAP earnings per share increased 27% year over year. Our results are stronger than we expected earlier in the year, and they require some unpacking to put them in the context of the full year. What I want you to understand is what we are focused on, namely making surgical changes to the way we are running the company. Some of these will have an immediate impact, and others will take longer to bear fruit. As such, we need to maintain flexibility throughout this year to make important decisions to drive the long-term growth of the business. This includes decisions about where we prioritize and reinvest, how we go to market, and actions that can be taken to sharpen our value proposition for consumers and merchants. With that in mind, we do now expect full-year EPS to grow mid to high single digits, which is partially driven by our better-than-expected start to the year. Jamie will take you through our Q1 results, contours of the year, and updated guidance in just a few moments. Let me first spend some time providing an update on our execution against our customer strategies and investment priorities, and detail progress on our efforts to operate more efficiently. Turning to our three customer groups, we continue to make steady progress on strengthening our strategic positioning and product portfolio. For large enterprises, we continue to focus on accelerating growth in branded checkout and driving the profitability of our business. We are executing to get upgrades to our core branded checkout experiences to the market. We continue to make good progress in our early testing of Fastlane by PayPal with a focused group of merchants. And data from those alpha merchants show that returning Fastlane users are converting at nearly 80%. We are just getting started and already creating a low double-digit lift in guest checkout conversion for participating merchants. The results so far are encouraging, as incremental conversion improves our merchants' growth and profits. Demand for this product is promising, and we expect to make Fastlane generally available in the US in the second half of the year. Additionally, we are continuing to focus on making it even easier to pay with PayPal by removing friction from the checkout process. In the coming months, we will continue to move to more passwordless authentication processes like biometrics and launch a redesigned mobile checkout experience, which we believe will result in higher conversion rates. We've begun active discussions with our largest enterprise customers to focus on commercial outcomes that reflect the true value of our payments processing platform and the services we provide. As we speak, many of our top merchants are gathered in California for our annual Commerce 360 customer conference, where our teams will go deep on the innovations we plan to bring to market this year and the value they can provide. We are also in the early stages of evaluating the overall dynamics and pipeline of our top 10,000 merchant accounts. As we evaluate our programs, we see clear opportunities to price to value, not only with our PSP processing, but especially with our value-added services that we already provide. Services such as payouts, fraud prevention, and processing orchestration. This process will take time, but we have a focused game plan, and we are already having fruitful conversations that are helping merchants understand the additional value they can unlock by strengthening their relationship with us, including through our value-added services. For example, DraftKings recently went live with our fraud management solution, Fraud Protection Advanced, which combines our intelligence with advanced machine learning and analytics to help businesses protect themselves from ever-evolving fraud threats. This is an example of a best-in-class offering and a key differentiator against our competitors. It also showcases our ability to leverage AI to drive customer benefit and is an area where we can price to the value we provide. For small and medium-sized businesses, the launch of our PayPal Complete Payments platform has been gaining momentum over the past couple of quarters. We've made good progress in expanding PPCP's geographic reach to now more than 34 countries. In the first quarter, we expanded the platform to Canada, the UK, and more than 20 European markets. We also added new features to PPCP in Australia, Germany, and the US in recent months. Additionally, we are seeing positive response to our new low and no-code tools for merchants and developers to integrate PPCP, which we launched in March. As of the end of the first quarter, approximately 7% of our SMB volume is already on PayPal Complete Payments, with our team focused on distribution through partners that can accelerate adoption to the largest number of customers. Our efforts here are important because PPCP ensures merchants have our latest branded checkout integration, which will include Fastlane, so that consumers have a best-in-class checkout experience wherever they shop, and merchants will benefit from higher conversion. On average, merchants who adopt PPCP use approximately 4 PayPal products, which deepens the relationship and reduces churn. This translates to an average revenue per account for a PPCP full-stack merchant that is nearly 2 times that of an SMB on a legacy integration. As you all know, I have a deep passion for helping small businesses succeed. Frankly, this is an area where PayPal took its eye off the ball. Over the years, we've deprecated products and made pricing decisions that negatively affected our market positioning. Despite that, we still have the largest population of SMBs anywhere who are using our products and eager for us to do more for them. This is an area where we are investing to correct our course. We are here to serve and win the small business market. On the consumer front, the PayPal app is at the center of our strategy to leverage the power of our data to create more value for our customers and unlock new sources of revenue and margin expansion opportunities. In the first quarter, we revamped the PayPal app with a new look and feel and introduced enhancements to our rewards program to enable shoppers to get the most out of their money while increasing conversion for merchants. Additionally, we began testing a comprehensive rewards-focused lifecycle marketing program. When tested with approximately 20% of our PayPal app users, we saw it drive a nearly 7% increase in weekly app logins and 4% increase in transaction margin per user. Introducing consumers to new products like our debit card that can help maximize the value they receive from PayPal is a major focus. The enhancements our team made to our onboarding flow enabled a 38% increase in debit card first-time users during the first quarter. On average, a customer who adopts the PayPal debit card is more engaged, generating a 2x lift to transaction activity and a nearly 20% increase to average revenue per account compared to users who primarily use checkout. Approximately 4% of our active PayPal consumer accounts in the US have a debit card. So while we have a lot more to do, this work is meaningful to the economics of our business. In the quarter, we onboarded BigCommerce and WooCommerce to our package tracking solution. In the 12 months since launch, we've had approximately 7 million active accounts use package tracking. This is a key pillar in our post-purchase strategy. Package tracking not only allows consumers to track their shipments within the PayPal app, but will also enable us to make personalized purchase recommendations and present relevant offers through the app and our AI-powered smart receipts. We believe these innovations will drive engagement with the PayPal app and incentivize future branded checkout activity. For Venmo, we are focused on giving our customers more ways to immediately use their Venmo debit card in person with Apple Pay and Google Pay, which you will see in the market in the coming months. In the first quarter, we saw a 21% year-over-year increase in consumers using our Venmo debit card. Remember, Venmo debit card holders are among the most engaged accounts and on average drive 6 times the incremental revenue than that of a P2P only customer. Simultaneously, we are making it easier for consumers to use their Venmo balance when making payments or sending money to friends. In the first quarter, balance-funded P2P senders grew by 17%, which contributed to our overall transaction margin dollar growth in the quarter. Our leadership team is continuing to go through our business from top to bottom, understanding where we can operate more efficiently and invest in the innovation that will offer the greatest impact for our customers and PayPal. This is a mindset shift we are driving throughout the entire organization. Investing for durable growth backed by a clear payback path and time horizon remains a top priority. Investing in branded checkout and better serving our small business customers are 2 focus areas you heard me talk about today. We are also actively evaluating and greenlighting new investments to accelerate future growth that support and strengthen our strategic priorities. A good example of this is our remittance business, Xoom, which has stagnated while similar services have gained share. This business has been on a negative revenue trajectory due to a lack of prioritization and clarity about its value proposition. That is now changing. We are executing the right product refinements bundled with an enhanced and more customizable pricing model intended to promote growth over the long run. We plan to reduce the cost of cross-border transfers and provide consumers the option to eliminate transaction fees altogether when funding with our PYUSD stablecoin. We are activating those plans, and we expect to see tangible progress throughout 2024 and beyond. The key takeaway here is that we are in the process of assessing a handful of areas of investment where we believe there are compelling unit economics and market upside. These may mean that we will make decisions to invest in 2024 where we believe these investments will ultimately contribute to the sustainable and profitable growth of the company. At the same time, we must maintain our focus. We are continuing to evaluate the markets we operate in and the products we offer. Where we see areas to improve focus and prioritization, we will take action and update you accordingly. Finally, a few words on our continued efforts to drive operational efficiency and productivity across PayPal. We are instilling a rigorous cost-benefit discipline throughout the company and leaving no stone unturned when it comes to reducing unproductive costs. We are also investing in automation that will help answer our customers' frequently asked questions, simplify the integration process for our merchants, and enable our team to deploy solutions more quickly. As mentioned on the last earnings call, we have started reporting stock-based compensation as part of our non-GAAP metrics beginning this quarter. In addition to our annual incentive plan shifting to cash payment from stock, we have also better aligned our incentive programs to performance, particularly focusing on transaction margin and non-GAAP operating income growth. We will continue to focus on a pay-for-performance culture that appropriately aligns pay with results. I'll conclude by thanking the PayPal team for continuing to innovate and serve our customers. While we are still in the early innings of driving a meaningful and comprehensive transformation of PayPal to deliver the sustainable and high-quality growth we are aiming for, our first quarter results are an encouraging indication of what our team's renewed strategic focus and persistent execution can achieve. We will continue to update you on our execution throughout the year and be transparent about our progress. I'm confident that we are taking the right steps to build long-term profitable growth. With that, I'll hand it over to Jamie to take you through our first quarter results.
Thanks, Alex. Good morning, everyone. We had a solid start to the year with first quarter results that were above our expectations. As Alex mentioned, it's still early in the company's transformation. We are getting deeper and understanding both our challenges and our opportunities with much greater clarity. Our goal for 2024 is to foundationally set up the business for the future by making key decisions and aligning our investment path for growth. And to do so, we are laser focused on strategic analysis and decision-making, driving innovation back into the business and executing with excellence. While it will take time for our efforts to sustainably flow through results, the speed at which the team is moving is encouraging, and we are making steady progress. Let me start with a summary of our financial performance. As a reminder, our non-GAAP results now include the impact of stock-based compensation expense and related payroll taxes. This change is intended to enhance transparency, operating discipline, and align our performance measures to how many investors already evaluate our business. Now moving to our results. As Alex mentioned, in the first quarter, revenue increased 9% at spot and 10% on a currency-neutral basis. Transaction margin dollars grew 4% year over year, improving in growth by more than 400 basis points from the fourth quarter. I'll walk through the drivers of that growth in a few minutes and provide context on the shape of the year, including tailwinds that we expect to be more pronounced in the first half compared to the second half. Under our updated non-GAAP methodology, earnings per share were $1.08, representing 27% year-over-year growth. Under the company's prior non-GAAP methodology, which excluded the impact of stock-based compensation, earnings per share would have increased approximately 20% to $1.40, above our guidance for mid-single-digit growth on a comparable basis. Relative to our outlook, higher earnings per share were driven by a combination of factors, including better-than-expected transaction margin dollars, ongoing expense discipline, the timing of certain investment and marketing spend, and interest income. Now I'll walk through some key operating metrics that support those results. We ended the first quarter with 427 million total active accounts and 220 million monthly active accounts. Total active accounts increased by nearly 2 million from the fourth quarter and included growth in PayPal merchant and consumer accounts, in addition to other products. We were encouraged to see total active accounts inflect positively in the quarter, and we remain focused on driving deeper relationships and more activity across our customer base. Monthly active accounts continued to show steady progress, up 2% year over year to 220 million, with contribution from both PayPal and Venmo. Transactions per active account, which is a trailing 12-month number, was 60 in the first quarter, up 13%. Excluding PSP processing, which is primarily Braintree, transactions per active account grew 7%. Moving to volume growth, in the first quarter, TPV grew 14% on a spot and currency-neutral basis to $403.9 billion. U.S. TPV grew 12%. International TPV grew 17% on a currency-neutral basis, primarily driven by strength in continental Europe and improvement in Asia. Global branded checkout growth accelerated to 7% on a currency-neutral basis from 5% in the fourth quarter. The first quarter included about a 1-point benefit from Leap Day, as well as ongoing benefits from the growth of global marketplaces. Within branded checkout, large enterprise and international markets were the biggest contributors to growth. We remain laser-focused on driving deeper adoption of our best-in-class solutions with small and medium-sized businesses and improving our mobile experience, which are critical, particularly in markets like the U.S. and the UK. PSP processing volume grew 26% in the quarter, driven by continued momentum from Braintree compared to 29% in the fourth quarter. Conversations with merchants have been encouraging as we shift our focus to a more disciplined go-to-market and renewal process that emphasizes a focus on profitable growth. Merchants recognize the product and performance improvements we have already started to make and are excited about the pipeline of upcoming innovation. As I noted earlier, revenue in the first quarter increased 9% at spot and 10% on a currency-neutral basis to $7.7 billion. Transaction revenue grew 11% on a spot basis to $7 billion, driven by Braintree and branded checkout. Other value-added services revenue in the quarter declined 2% on a spot basis to $665 million. Within other value-added services, interest on customer balances continued to be a meaningful tailwind. Our credit business performed relatively in line with our expectations, with revenue lower because of two main factors. First, we are carrying lower merchant receivables after tightening originations last year. Second, we have had lower revenue share on our off-balance sheet U.S. consumer revolving credit portfolio due to ongoing normalization of loss rates. Transaction take rate declined 5 basis points to 1.74%, driven primarily by lower foreign exchange fees and lower gains from foreign currency hedges. In addition, mix shift to large merchants continued to impact our branded checkout take rate. Transaction margin dollars increased 4% in the first quarter. Higher interest on customer balances, branded checkout, better transaction loss performance, and lower credit losses were the largest contributors to growth. While the performance of the core business has been relatively consistent, we expect that a few of these tailwinds are likely to be less meaningful as we move through the year. Specifically, we expect to see lower year-over-year benefit from interest on customer balances and lower year-over-year improvement on transaction and loan loss performance. Non-transaction related operating expenses declined 2% as we continue to actively manage our cost structure while reinvesting into key strategic initiatives. Part of the decline in operating expenses is a result of certain corporate and marketing investments deferred to the second half, as well as lower stock-based compensation. Non-GAAP operating income grew 15% in the quarter to $1.4 billion, and non-GAAP operating margin expanded 84 basis points to 18.2%. PayPal generated $1.8 billion in free cash flow in the first quarter, or $1.9 billion excluding the impact of held-for-sale accounting related to our European buy now, pay later externalization. In the quarter, we completed $1.5 billion in share repurchases, bringing share repurchases over the past 12 months to approximately $5.1 billion. We ended the quarter with cash equivalents, and investments of $17.7 billion and debt of $11 billion. I'll now move to our second quarter and 2024 guidance. Consistent with the approach we shared in February, we will continue to provide revenue guidance one quarter at a time. For the second quarter, we expect revenue to increase approximately 6.5% at spot and 7% on a currency-neutral basis. In addition, we expect non-GAAP earnings per share to increase by a low double-digit percentage. For the full year, we continue to plan for a relatively consistent macroeconomic and consumer spending environment. With respect to earnings per share, we now expect 2024 non-GAAP EPS to grow by a mid to high single-digit percentage. As Alex said earlier, we are in a transition year, and we do not expect that our quarterly progression will be linear. To help bridge this outlook compared to our prior guidance for approximately flat non-GAAP EPS, there are two main factors I would point you to. First, our inclusion of stock-based compensation expense within non-GAAP results is expected to benefit EPS growth by approximately 3 percentage points this year. Second, we saw meaningful outperformance in the first quarter relative to our plans. We intend to reinvest a portion of this performance back into the business. We expect earnings growth to be more muted in the second half of the year, due primarily to less benefit from interest income on customer balances, normalization in transaction and loan loss performance as we progress through the year, and the expected timing of investment actions. Underpinning our outlook, we now expect transaction margin dollars to be slightly positive for the full year. we expect non-transaction operating expenses to increase slightly. Embedded within this outlook is the flexibility to make key strategic decisions to invest and reinvigorate profitable growth within components of the portfolio and accelerate go-to-market efforts. For the full year, we expect other value-added services revenue to be roughly flat year over year. This excludes any potential impact from the CFPB late fee regulation, given pending litigation across the banking industry and uncertainty on both timing and implementation. As a company, we have already taken steps to mitigate the future impact, though these take time to fully take hold. Consistent with the approach we shared last quarter, our guidance includes minimal impact from the new innovations rolling out this year. Our focus is on execution as we begin moving from test and pilot phases into launch. We continue to expect free cash flow for 2024 to be approximately $5 billion and for at least $5 billion in share buybacks. In closing, 2024 is off to a solid start as we drive significant change across the company. We have clear opportunities to lean in further. We are doing the hard work now to position PayPal for profitable growth in the years ahead, and it has been incredibly energizing to see the team's commitment to this goal. With that, I'll now hand it back to the operator to begin Q&A.
Thank you. At this time, I would like to remind everyone, in order to ask a question, please press star 1 on your telephone keypad. We'll pause for just a moment to compile the Q&A roster. Your first question comes from the line of Tien-Tsin Huang with JP Morgan. Your line is open.
Hey, thanks so much for all the detail here up front. I want to ask on transaction margin dollars, if you don't mind, the acceleration there. Maybe can you give us a little bit more detail on the growth across the main businesses, branded checkout, unbranded, and what we've been calling other? And of course, on the other side, I'd love to hear if there's any change in thinking there on the strategy to reclaim growth or even divest some of those assets. Thanks.
Yeah, thank you, Tien-Tsin. Let me hand it over to Jamie to walk you through transaction margin, and then I'll take the more strategic piece on other and how we think about the year.
Morning, Tien-Tsin. I'll just walk you through the drivers for transaction margin growth during the quarter. We were happy with the positive growth progression. I mentioned in my prepared remarks, we've got a lot underway to really position the company for positive TM growth over time. In the quarter, just to walk it a little bit, interest income on customer balances was the highest contributor. Branded checkout continued to grow profitably and was a nice contributor to our growth this quarter. We did benefit from Leap Day, but we also benefited from strength in large enterprise and international. We've been very focused this year on PSP profitability, and that will ramp over time, but it wasn't a meaningful contributor this quarter. And we've just had small, but I'd say steady ongoing product improvements in Venmo and P2P. So we saw some shifting there and better transaction and credit loss performance. And then lastly, to the last point of your question, we did see smaller drag from the other smaller parts of the portfolio. I don't know, Alex, if you want to talk through that a little bit.
Yeah, let me just sort of take a step back, Tien-Tsin, and talk about how we've been thinking about the year. You've heard us talk about this as a transition year. The way we've really been focusing the team is on sort of 3 different components to make sure that we're set up well for profitable growth into the future. The first is accelerating innovation and ensuring that we've got best-in-class innovation, whether that's on the consumer side and ensuring that our customers have a frictionless, incredible experience in checkout, to an unbranded side where we allow our merchants to have, again, best processing available. So really accelerating the velocity of our innovation. The second is adoption and ensuring that once that innovation is actually in the market, that our consumers are using it, that our merchants are onboarding to our latest and greatest integrations. I'll give you an example. We talked about in the last call the opportunity for debit card engagement. We changed the onboarding flow inside of the PayPal app this past quarter and saw a 69% higher debit card engagement just by changing that flow. So a big focus on the team on not just delivering our innovation, but actually delivering the adoption.
And then lastly, as you mentioned, cleaning up some of our underperforming services. I mentioned Zoom on the call. That is a business that we looked at very hard. It's been underperforming for a couple of years now. And we wanted to make a decision on, is this an asset that's strategic to the business that should be a profitable grower for us or not? And when we looked at it, we realized that there were just opportunities where we had priced ourselves out of the market in a number of different corridors that we could make strategic decisions on and actually make this a profitable growing business. And so that's just an example. We're going top to bottom throughout the organization, and there will be some businesses or markets that don't meet that cut, and we'll let you know when we make those decisions. And there will be other ones that, with focus and execution, will turn around.
Got it. Appreciate it. Thank you.
Your next question comes from the line of Darrin Peller with Wolfe Research. Your line is open.
Hey guys, thanks. I think it would be helpful if you don't mind just first revisiting some of the initiatives around unbranded and your conviction and the timing around the impact from them on perhaps on transaction margin. But maybe even more specifically, if you've had discussions with Braintree merchants around pricing, and I think you touched on some of the prepared remarks, but more pricing to value than pricing to win. How are those conversations going? And I guess, Alex, market-wide, when we think about the appreciation of the value-added services and differentiator for PayPal's two-sided network, how's that been resonating in the market lately?
Yeah, thank you, Darren. So again, just to sort of paint the high picture on unbranded, this is an important segment for us, both for enterprise and for small business. We have to nail the basics, right? So our customers are looking for the best auth rates, the best uptime, the best availability, the best reliability, and those are things that we are now providing. And I think over the last few years, as we've been building the service, whether it's Braintree or now with PPCP, we've been investing in that and establishing a beachhead for our product across the market. In doing so, though, we also have been building value-added services that, to be totally transparent, we haven't been able to price to value, or we haven't been able to ensure that we're engaged with our customers in a real end-to-end strategic conversation. That's changing now. And so to your question, we're having great conversations with both enterprise and small business merchants around our end-to-end solutions, the value-added services that we can now bring to bear, really more strategic conversations, as you mentioned, around the two-sided network, both an unbranded, a branded, and then even things like our new marketing and ad platform in the mix. We're now having really deep conversations with our merchants that, again, are strategic for them and extract the value of the services that we're providing. So very encouraged with these conversations. Obviously, it's going to take time, especially for some of the largest merchants. It just takes time for them to roll out and adopt. But our teams right now are, as I mentioned on the call, in LA with our Customer 360 conference and showing them all the innovations and having really, really good conversations. So encouraged with the start. It's just going to take time throughout the year.
Got it.
Your next question comes from the line of Timothy Chiodo with UBS. Your line is open.
Great. Thank you for taking the question. I wanted to explain two parts, really, one around mechanics, one around the uplift. On the mechanics, there might be two ways to go about this. One is to make it a part of your unbranded offering, and it could be either part of your negotiations on pricing, it could be a separate fee, but any way you look at it in that scenario would be more of a if Fastlane, then Braintree does the processing. But the alternative way would for it to be more of a as a service and available on a processor agnostic basis. One, to see first if you can give us color on which routes you might be able to take, or maybe both. And then lastly, on the uplift, which is, if we think about the range of net take rates with unbranded at the low end and branded at the high end, where do you think Fastlane could eventually reside on that spectrum? Thanks.
Yeah, thanks, Tim. Let me take the first part and see if Jamie wants to add anything in. We are really excited about Fastlane as it now gets to market. We are live with a handful of early partners, and the results just continue to impress. And just as a reminder, we're now enabling 80% conversion rate for returning users through a guest checkout flow. What's even more exciting that we've now been able to start to see with these early merchants is that we're actually seeing unrecognized users. So these are non-PayPal users opting in to Fastlane at a 40% rate. That just shows the power of our brand, and it shows the power of what PayPal can be. And it goes a little bit to your question around how we think about pricing it and how we think about go-to-market, because it's even beyond just an unbranded processing element. I don't want to unveil exactly how our go-to-market will work, but that data point shows that this is not just within a PayPal ecosystem. This is allowing us to actually take the brand that we've established over 25 years and leverage that for our merchants to deliver incredible checkout conversion rate for the 60% of the market that continues to go through a guest checkout experience. So we're really encouraged by the early signs there. In terms of rollout and how we think about it, obviously on the PPCP side, as we continue to deliver Fastlane to that platform through many of our platform partners, becomes easy for our small businesses to one click turn that on. So that will be a big part of our rollout, and then having good merchant conversations as well on the large enterprise side. And again, those are kicking off really in earnest this week at our C360 conference. So again, the last thing I'd say just on pricing, and then Jamie, see if you want to add anything, is because we've focused this year on a transition year, we may get very aggressive on the pricing side when it comes to Fastlane for 2024 because we want to drive adoption. We think this is a best in the market innovation that all merchants should have access to. And as they think about winning this shopping season, our encouragement is improve the onboarding for them, create low code, no code opportunities for them to get up and running as fast as possible so that they can win this season and really prove to themselves that conversion improvement. And rest assured, we'll be pricing to value over time to ensure that we get the right value from that. Jamie, anything you'd add?
No, I think you've said it all. I really think Fastlane reinforces our holistic value prop, both for branded and for unbranded. And the focus on merchant checkout conversion and that being at our core, I think drives a strong value prop, and it will support strong pricing over time.
The only thing that I would just last point is this conversion rate with Fastlane. What's so exciting to me is not just the 40% that's coming in as unrecognized users leveraging our brand and the 80% conversion rate of guest checkout for returning users. But this is just early days. This is with a handful of merchants. This is a network effect. As we gain more and more users coming through, as these users now become returning users over and over again, those rates should continue to improve. And so this is already an order of magnitude better than anything else in the market. And with the network effect and scale that we have, we just expect it to continue to get better.
Excellent. Thank you.
Your next question comes from the line of Ramsey El-Assal with Barclays. Your line is open.
Hi, thanks so much for taking my question this morning. Alex, could you comment on the European Commission ruling to open up the iPhone NFC hardware on the handset, and whether you see that as a competitive opening for PayPal in Europe? I know there's some rumblings in the US as well about that type of a move. I mean, how ready from a product perspective are you to take advantage of a more open NFC environment? Thanks.
Yeah. Thank you for the question, Ramsey. So let me set the context so that it's clear how we think about it. First, we must play in an omni-channel world. We have established ourselves as the leader in the market in online, and our customers love us and use us globally for online checkout. But they are demanding an offline opportunity, an omni-channel opportunity, and to get the value that we're able to provide as we start to deliver not only the basics of our security and flexibility, but also as our rewards platform continues to improve. We want to be able to deliver a PayPal service for customers everywhere, anytime, every purchase. So we will be playing in an omni-channel environment. That where there are locations where NFC opens up, that obviously becomes a very easy opportunity for us to provide a wallet in an Android or iPhone operating system, and we will be ready. If there are environments where it's not available, we will still operate in an omni-channel. So omni-channel is a strategic initiative for us. It's something that is customer back and delivers an incredible PayPal experience, again, for every purchase and every checkout. And we'll take advantage of whatever market, whatever features and functionality we have in whatever market we play in.
Got it. Thanks.
Your next question comes from the line of Jason Kupferberg with Bank of America. Your line is open.
Good morning, guys. I just had a two-part question. The first, just following up on the transaction profit dollar growth. I know you're now expecting slightly positive for the year. I guess that would seem to imply maybe a little bit of deceleration from the Q1 levels, even though the second half comps are a little easier. So just wanted to get a sense of whether, that's conservatism or just some normalization of things like transaction and loan loss that helped you in Q1. And then the second part is just, is there any change in your full year expectations for branded payment volume growth? Thank you.
Good morning, Jason. So just to walk through a little bit of the first half, second half dynamics on transaction margin dollars, as I talked about before and you noted, Q1 in particular benefited from a few tailwinds, and we do expect those will be less meaningful as we move throughout the year. First of all, the growth in our interest income on customer balances, it was the largest contributor. But when you start to look at later in the year, the comps just get more challenging. Rates were rising in the latter half of last year. We also saw improvement in transaction loss and credit loss in the first quarter. Transaction loss in particular may not sustain or may not be as material as we move throughout the year. And we saw, as you pointed out, a meaningful benefit in loan losses in the first quarter, and we don't expect that to continue either. So, I'd say those few things are some of the dynamic, and then our initiatives and some of the new innovation that Alex talked about, it will take time to ramp. So right now we're focused on execution. We want to keep expectations measured until we see really steady execution results.
Yeah, and just to underline Jamie's point, we have put limited upside to this innovation that we've talked about in these expectations. And so again, this is about us having the flexibility, us ensuring that we take the right time and do the right thing by the customers, as well as building the long term. But those are not built into to the rest of the year.
Yeah, and you asked about branded as well, and when we look at that, we had a nice quarter in terms of TPV and revenue. It was a healthy contributor to our transaction margin dollars. We did have some benefit this quarter from leap day, but by and large, we expect branded revenue trends to be pretty consistent with last year as we look at that. And I guess the other comment I might make is that when you think about take rate for us, we saw a decent drop last year. We do expect take rate will come down again this year, but not nearly to the same extent. And a little bit of that, as it comes through on the branded trend line, is just that we're seeing a little bit of mixing towards large enterprise from SMB, and that's impacting the take rate side.
Thank you.
Your next question comes from the line of Mike Ng with Goldman Sachs. Your line is open.
Hey, good morning. Thanks for the question. Just two for me. First, I was just wondering if you could just talk a little bit more about the drags on the smaller part of the portfolio on transaction margin dollars. When does that kind of work itself out of the system? And then related to transaction margin dollar growth, you talked about balance funded Venmo transactions contributing to growth in the quarter. Could you expand a little bit on that? Do you see that scaling over the next couple of years? And what are the opportunities to improve card attach for Venmo users? Thank you.
Great. Good morning, Mike. On the smaller parts of the portfolio, I guess what I'd say at a macro level, we had seen a pretty significant drag on that last year. It is coming through this year at a smaller rate. Part of these are products we've deprecated. Some of these are, frankly, acquisitions that we just haven't invested in. And as Alex mentioned, we're going through a process of really looking hard at these. Candidly, some are just in decline, but the declines are smaller. And some we're investing in or making decisions to really put in more in maintenance mode, which is really shifting the profile going forward. But it will be smaller this year, and it'll take a few years for that to burn off.
Yeah. Let me talk about, up levels and talk about Venmo for a minute, and the opportunity there. So again, on the positive side, we have, the leading P2P platform, with incredible customer base, with disposable income 22% higher than the US average, 60 million monthly active users and 90 million 12-month actives. So this is an incredible platform for us to work at. As we've talked about in previous calls, and I'll reiterate here, I'm dissatisfied in how we've really thought about monetizing the platform, and really thought about delivering, in many ways, just customer experiences that they're looking for, right? Customers of Venmo are looking for dollars, and looking for an alternative to traditional mechanisms when dollars are flowing in, and they want to be able to use Venmo for all of their expenses. Just to give you, put some numbers behind it, there's $18 billion of net new funds that flow into the platform of Venmo every single month. 80% of those dollars leave within 10 days. That is just unacceptable. And so our ability to provide the products and services that our customers need when those dollars come in, whether that's improving debit card penetration, which you've heard is a focus, and you've heard we already in some of our onboarding flows are starting to make significant improvements on, or providing other opportunities for money in or money out opportunities, and access to capital for our Venmo users. This is just a clear opportunity and a clear focus area for us. So again, early days, the team is focused on it. Hopefully you hear sort of a reinvigoration in my voice of what Venmo can be, and the opportunity ahead of us, but very, very excited about where we're taking it.
Your next question comes from the line of Brian Keane with Deutsche Bank. Your line is open.
Hi, good morning. Solid first quarter results here. My question is just still more on the big picture. The naysayers on PayPal would say the company is structurally challenged with the rise of payment methods like Apple Pay. Alex, I know you've been at PayPal now for a little over 6 months. What do you think the naysayers are missing on the competitive advantages PayPal still has in the market, in particular to grow branded?
Thank you, Brian. Thanks for the question. So a couple of thoughts here that I think people are maybe not appreciating enough. The first is 60% of the market is still what I would consider to be non-consumption. 60% of the market still does not use any mark. So that's what we're playing for. We have the best brand, we have the best products and services, and the best ability to be able to deliver. And with products like Fastlane, not only delivering a reboarding opportunity for our customers, but that stat that I put in earlier, around 40% of unrecognized customers coming through and taking a Fastlane experience now gives us an opportunity to be able to remarket to them and turn them into PayPal customers. So step one, 60% of the market is non-consumption, and I think we've got a leading opportunity there. On the other 40%, we're still the leading player. And to be, again, transparent, and I've said this before, we have not delivered the innovation and the experience that I would expect and that our customers expect. We are doing that now. An improvement in the app, an improvement in the branded experience, reducing latency by 50%, investing in passwordless opportunities and passkeys will improve the conversion rate and improve the experience, and then creating value-added opportunities and an increased value proposition for our consumers with rewards. I think we're the only player out there at the scale that we have to provide that end-to-end experience. And again, we provide everything for our customers. It's rewards, it's buy now, pay later, it's a debit experience. And back to what I mentioned earlier on the call, with an omni-channel play now, PayPal can be the solution that you can use anytime, anywhere. So our ability to now start to play in an offline world and take the same brand and the same experience to every purchase, I think is something that, again, gets me excited. But we've got to prove it, and we've got to continue to execute and create great experiences in the market for our customers.
That's great. And just had one follow-up. We are getting a few questions on the pending CFPB regulation on late fees. Any impact on PayPal from CFPB caps on late fees?
Yeah, Mike. So first, while PayPal's not directly impacted by that regulation, we are indirectly impacted through our revenue share with our consumer credit partner. There's a lot of uncertainty right now around both timing and implementation of that. And as I mentioned before, our guide excludes the impact of that, just given the uncertainty. The industry expects that if implemented, the impacts would be largely offset over time. And we have been very focused on mitigation. We have actions underway. But really, in any scenario, it takes time for those offsets to fully set in. But I guess what I'd say in terms of impact is, the date that's being debated right now is a May 14th implementation date. And if that were to be implemented, it would be approximately a 3 percentage point impact to EPS growth for the year. But that is before mitigation. So by 2025, we would expect roughly half of that impact to be offset and then more over time.
Thank you.
Your next question comes from the line of James Faucette with Morgan Stanley. Your line is open.
Thank you very much. I wanted to go back to Fastlane, and Alex made the comments around making Fastlane available to all merchants and derive it so that they can derive the benefits of it. How should we think about that in terms of what needs to be done, timeline for progression, et cetera? It sounds like you're going to start moving beyond at least those initial merchants that are using it now, but just trying to think about how that ultimately could end up with most of the merchants served by Braintree, and then ultimately the merchants served by PayPal more broadly.
Yeah, thanks, James. Here's the best way to think about it. First and foremost, we have to have the best innovation in the market. It was important for us to get some early customers up and running and using it, and the data continues to hold and certainly delight these merchants. And look, in this world, they all talk to each other, and so the ability for our merchants to now be rabid fans of the checkout conversion improvement that they're seeing through Fastlane is great proof points for us as we now start to scale it and again think about price to value. The second leg will be, okay, now that we've proven this out and we've started to really, we're, just to be clear, we're talking about driving conversion rate for some of the largest merchants in the world. We need to make sure that this was proven and that it works before we roll this out at scale. There's a lot on the line to be able to nail this, which is why we're moving at a measured pace and ensuring that in Q1 and Q2, we've really proven it out. The conversations we're having at our C360 conference right now, the conversations we're having with some of our PPCP platforms that are now rolling it out to small businesses is, okay, what is the way that as we get to the second half of the year, we can really enable the merchants to have this up and running so that they can win the shopping season and the holiday season in the back half of the year. So that's how we're thinking about it. Merchant demand is very encouraging. As you would imagine, when you have a product that improves conversion rate and provides a double-digit lift in guest checkout conversion, that's a game changer. And so demand is high. We want to make sure that we have as low friction an onboarding experience as possible, which is why we wanted to make sure that the ability for folks to upgrade to the new integrations would make sense and be easy for them. And we wanted to make sure that customers could onboard. So the plan is back half of the year, get as many merchants on so that they can win the holiday season. This will still take time. Not everyone will get on for this holiday season. And we expect that will continue into 2025. But at some point, there will be a tipping point. If I think about over the next year or 2 years, where we are going to expect all of our merchants to be on the latest and greatest integration, which includes Fastlane. And we will then move to deprecate our old integrations. And that's going to be an important milestone for us as we take what is really 15 years of legacy integrations and consolidate them on a more modern stack and a more modern integration for our customers. That allows us to continue to build innovation, continue to drive the best experiences for merchants, for customers, and obviously the best transaction margin results for the company as well.
That's great. I appreciate the color there, Alex. And then you mentioned you were getting a little bit of improvement in Venmo transaction margin. How much of that is coming from increased acceptance of Venmo as a payment option versus finding ways to reduce costs in transacting Venmo and P2P transactions, et cetera? Just trying to understand kind of what the drivers there are and what potential could be.
Yeah, it is a combination. What I'd say is, we're seeing Pay with Venmo really starting to take off. Obviously, it's in the U.S. it's an incredibly well-loved brand, and when people see that button, it's an opportunity for them to use those dollars that I mentioned earlier that are in their account. So that's an exciting piece online. The piece that, again, I'm sort of dissatisfied with, but excited about the future is the offline piece, right? When I talk about omni-channel, it's for PayPal and for Venmo. And so those, billions of dollars that are coming in every month into the Venmo ecosystem, we have to continue to give our customers opportunities, whether it's debit card penetration or other innovation that we come up with for them to be able to, tap and pay and check out. And so all of that will move towards improving transaction margin. That said, we're also getting better with our risk models and leveraging AI. We are, there's a lot of AI conversations in the market. I would say we are one of the leaders when it comes to leveraging the data that we have at scale to improve our transaction losses, improve the customer service ability for our customers, and improve our transaction margin over time. So still, again, early days, there's a lot of work to continue there. But again, my excitement for the path and the direction for Venmo is pretty high.
Thank you.
That is all the time we have for questions. I will turn the call back to Alex Chriss for closing remarks.
Fantastic. Thank you, Sam.
Okay, I think we'll end that there because we got the market open. Thank you, everybody, for being here. We'll be on for just a little bit talking about what we've got. The stock market is now open.
Wait. Is that for PayPal or is that for the stock market?
That's for the stock market. It's not for PayPal, but if PayPal ends green,
I think it should be.
Then it's for PayPal. $70, not bad. I mean, it's holding green. Jesse, what are your thoughts on the initial price action right now?
From a price action standpoint, I can show you real quick. So if you pull up my screen here, so we're at the 100 moving average, a little bit underneath of it. We've got a big volume shelf up over here. But when you compare this to the heat map today and where the markets are, I mean, unless you're Eli Lilly and Cat and 3M, it's good to be PayPal today. So I'm fucking stoked. That conference call was great from every aspect.
I think the conference call was good as well. Neil, what were your thoughts on the initial conference call?
Yeah, no, I like it. I liked it a lot. This is the Alex Chriss that we wanted to hear. I mean, even I think he noticed that last time we wasn't that excited. He gave us lots of information with regards to Fastlane, focus group, conversion rates. I mean, it's some of these numbers are pretty impressive. So yeah, very, very happy with the call. And now continued execution is key. But so far, stock is holding up on an extremely red day. So I guess that's a big positive.
I think that's a big point. I mean, Jesse said it was a red day. He showed that heat map. And so we're seeing the stock still stay green. I think I also think Chris crushed it. He even said, I hope you hear the reinvigoration in my voice.
Yep.
I mean, for someone to be that honest and transparent, basically acknowledging, last call I fucked up, but like I'm ready and I'm here. And the sophisticated intricacy of details with responses to the questions, I thought it was amazing. I thought it was awesome.
Well, I was going to say too, like on a more detailed explanation, there's a bunch of stuff I loved in that call. I love that they're pushing Fastlane. I love that they're talking about maybe potentially getting a hit in margins to be able to reduce the cost of Fastlane so that they can get the product out there and in more hands. I love that they talked about PayPal Complete is really 4 different products and that They have less churn when they're pushing that product because people are more invested in the network, and that they do 2x better than standard SMBs, and that they have the largest allocation of small businesses on the planet for a payment processing company. People are, I don't understand it. People are like, oh, how are they going to pull in all these customers? There's so many different fucking products. This is the biggest payment processor in the West.
Yeah.
By a large margin. There's nobody even fucking close.
Yeah,
So
it's number one on every app store around the world, or at number
everything.
10.
And now they're finally making it better. They sat on this fucking product since eBay and didn't do anything with it. And now they're actually making it better. And I love he said on the consumer side, 70% increase in weekly logins from the recent changes they were making. And it's still not that good. So imagine how much better that can get in the future. I love the advertising part. I think that's going to be huge. I love that they said that they're trying to get people to use their debit card more. And they saw a 30% increase in Q1. And they said, what did they say? They said only 4% right now utilization in that. And there's huge growth potential. I think that's amazing. I love that they're working to take the strength of Venmo and integrate it in with the rest of the product. I love that the Zoom payment remittance service that they were talking about was a dying product, and now they're looking to incorporate it in, and that they talked about right after that PYUSD and making their stable coin something that's going to be a more prominent part of the business that they're going to use for lowering the cost of cross-border payments. I think that these guys are firing, and there's so much more. I don't know. I think that they're firing on all cylinders. Even scary CFO lady sounded almost excited.
Sounded good.
Today.
Didn't sound that bad. Yeah.
She actually sounded excited. I think that's as good as it gets. So I'm stoked. I think that this is a great fucking company. I think there's no place to go but up. And I think the fact that they probably still have over $10 billion in buybacks that have been approved, sitting on the sidelines, waiting to pick this stock up is going to be great. And there's no short interest on the stock. There's 2% short interest. So we probably won't get a massive leap today, but we just had a second higher high, second higher low. The technicals for this stock are the best they've been in over 3 years. So, and the stock is still down 79 or what was it? 77.5% from its all-time high. That was, 1,200 days ago.
Yeah, and I think the reason it's down right now, guys, or it's not as green as it was, because I mean, look at the market, right? Market's kind of taking a hit. So the fact that it's still maintaining 3%, it's not bad at all. Yeah. Let's talk about a bunch of other stocks while we're here and just go through what's going on. SoFi, Neil, raw reaction down 5%. What do you think?
Thank you for telling me.
I just put it in order to buy 10 more contracts. Let's see if they fill.
It's. I mean, for me, it's getting very, very tempting to buy a bit more since my average is in the 7s. So yeah, I mean, down another 5%. I'm not surprised because, I mean, if we look at all the other stocks today, the big ones, that they're all down quite heavily. So yeah, SoFi being down another 5% today, I'm not that surprised. But it's getting attractive, I think. I'm looking. Yeah.
Jesse, your thoughts on MicroStrategy? This one's getting hit 8%. Earnings weren't that bad yesterday, but this is more Bitcoin related.
Yeah, well, I mean, you got to realize this. So they have, what do they have? They have 15 billion in Bitcoin. Yes. And that's like 99% of their valuation as a company. And they were being valued at 22 billion. So you're paying a massive premium for MicroStrategy. But I will say this, I think the premium could get 2 to 3x. And so it's going to be stupid. This company, are they already bouncing? They're already bouncing.
Yeah, they're bouncing from 1162. Yep.
Yeah. So this thing, the level of short interest is so high. This thing will rip the face. I won't say fuck because I know some people get offended by that, but it will rip the fucking face off of shorts badly. So
why should someone not buy options on MicroStrategy?
Why would they what?
Why should someone stick to stock versus options?
They shouldn't. Don't buy options on anything crypto related. They all suck. They were a great idea a year and a half ago when I was doing them, when Bitcoin was closer to $15,000 to $20,000, and nobody bought options, and you could get 10x. When CleanSpark was in the dollars, it was a great idea. Right now, you're taking on a bunch of additional risk. And if you don't hit your price target, and it's hard. So first off, anybody doing January 2026 calls is an idiot because those will never pay out. Never. The cycle will be over by then. If anything, it's historically over by months, maybe even a quarter normally. And with Bitcoin's going to really blow its jizz this time around because we've got ETFs out the wazoo, including ones in Hong Kong. And we've just got so many pipes of inflow available this time and so much more of a reason for people to buy it versus historical. And then we have this week, we have MicroStrategy and we have Michael Saylor with doing his convention. And they're going to be talking about a bunch of companies that are putting this stuff on their balance sheet now. And they're going to be trying to recruit more people to do it. And there's great incentive to do that. So don't buy Bitcoin related options when they maybe, if you're lucky, can 2x the underlying. Buy options when they can give you 5 to 10x the underlying, at least 3. Don't take additional risk. It is a zero-sum game. You're either going to make money or you're going to lose it. And 90% of people lose money in options. So I'm not in them right now. I don't think it's wise. People think I just love options and I sling them all over. There's a time and a place for them. It's a tool. Don't use it when it's fucking stupid. That's my take. So go.
I would agree. Amazon 181, Google 167, Apple 172, Chipotle, they're going to split in a couple of weeks. Snapchat 1481, they had a nice revenue beat last quarter. Snowflake 157, Teladoc 1332, Roku's up about 2% of the day. Not a lot of green. Again, PayPal still holding 3%. We'll see if it can maintain it. If Jerome Powell is nice tomorrow, maybe this thing goes back to 74, 75, and it actually has the earnings pump that it should have. If not, even if it stays at this level, it's not the worst thing. I think, what are your guys' thoughts on this? When a stock does a certain type of price action, it kind of signals to the market that it's able to get there, right? So when we saw Palantir go to 27, obviously it came back down, but the market has a willing appetite to buy it at those levels. Since we saw PayPal at 72 this morning, that's good, right? Because eventually the market might be able to get back to those levels.
Yeah, I think that if it depends on what it is, right? If somebody rings a cowbell and then all of a sudden the ticker starts dropping like a motherfucker, it might not be a great sign for the future of it. But this was different. This was a great conference call. They're really clear on what they're doing. They're talking real. They're not just like throwing out fluffy verbiage. They're talking strategically about all these aspects of their business. And right now I'm looking at Seeking Alpha. It says that there are 51% of the analysts, Wall Street analysts, say this is a hold and they're not recommending buying yet. But this company can net $1 billion in a quarter like it's nothing. And has been buying stock back aggressively and now is finally looking at growing this business, the most powerful payment business on earth. So I could see just tons of these analysts flipping around and taking buy positions, taking strong buy positions.
Yeah.
Yeah,
I think that's fair. I think a lot of it can change, right? Yeah.
Yeah. I mean, before the earnings on Seeking Alpha, I saw there were way more down revisions with regards to EPS. I think now we're going to see the exact opposite.
Yeah.
I mean, this earnings call was great across the board, Fastlane adoption, 40% of unknown users opted in PayPal Fastlane for payments on guest checkout. It's only the start. I did note something, but I'm not sure I caught it right with regards to Venmo, the amount of money that flows in. Was it $18 billion and then 80% leaves within 10 days?
Yep.
He was not very happy with that, which again is a huge opportunity to monetize that front. I mean, it's a huge ecosystem. They're not monetizing it. They're growing in a profitable way. I think that's a very, very good point that they keep on repeating. So that $1 billion in free cash flow each quarter should grow over a long period of time. And then they can buy more and more stock. So yeah, right now the market, like we said, the market is red. Yes, we were above 70, so there is a will to go higher. But then again, I think PayPal should go higher, much higher than just $74.
So we got Tesla here at 190. I mean, it's down 2%, but still maintaining 190. Jesse, thoughts on this one? Do you think it should come back down another 10% to come back to earth, or it's running to 200?
It doesn't have to for any period of time. I think the China related news is pretty huge. If they get approval, so they're already doing an enhanced autopilot. They already set up subscriptions on that in China just this last week, so that they could start making more revenue on that. And these are just like pure margins, man. They're like a 95% profit margin, right? Like they're huge. And so this company is quickly changing from a car company to a company that is going to be a SaaS business, software as a service. And they're doing that. And again, it's not even just that; it's the fact that they, met with the premier and they got the approval from the data side. China doesn't let anybody do anything with data. We've got a huge trade war. We've got, growing threats of World War III between us and China, but their economy is so bad off that they gave approval for Tesla to be able to basically set up FSD, to use their map system over there, and to be able to get this thing going, because they want to show to the West that they can work with Western businesses. And so I think it's a steal. It could drop. It could fill the gap. We did go up 15.5% yesterday, which is a crazy number, but I think it's a steal where it's at. And I think it's going to continue to go up. I only sold like a little over 100K yesterday because I just saw the opportunity to, and I knew that we'd probably get a little retracement from a technical standpoint, but the company is insanely sound. In the extremely bad quarter that everybody thought they were going to have, they looked at it and they're like, wait a second, how is this possible? How are they reducing COGS? How is this quarter not worse with the massive reduction they had and the cars being sold and all the discounts? How is it they could still do as good as they did? And I think that's going to continue. I'm a huge bull on Tesla. Huge.
Plus, you have Megapack factory in China, which is going to take.
And there's. Sorry, Neil.
Yeah, no, the Megapack factory in China is getting overlooked because everybody's focused on that FSD news. But we should be getting. I mean, if we're looking at the Megapack factory right now in the West, which is in the United States, the positive effect of that on the business is already immense. So imagine what happens when that ramps up in China. It's going to be huge. Plus, I believe next earnings report call is going to be a week or two just before the 8/8 event. So that's going to be quite something. But I mean, lots of things to get excited about. Of course, we still expect EV pressure throughout the year, but every other aspect of the business is looking quite okay.
Yeah, I would say the auto sector is screwed right now. It looks horrible, whether it's used car or new. The competition against each other is insane. And then with all these, and you made a really good point, Neil, that I want to add to. People aren't paying attention to the fact that lithium prices have dropped by over 85% in the last year and a half from their high. If you're looking at the CNY, basically the Chinese market, which is the only one that matters. And they're not paying attention to the fact that these are huge margins for Tesla because, and they've got years of Megapack demand. And so they're spinning up refineries here. They're spinning up their battery division here. They're going to do that aggressively while they step back. Again, there's a reason they're not building out Mexico. There's a reason they haven't talked about India yet. There's a reason why they're still going to get to 3 million cars, but they're going to do it with their existing factories. And it's because they're refocusing their energy on the higher margin business at a time where they don't want to have a bunch of risk related to selling shitty cars that make no money. Now, Tesla makes $7,200 a car, which is insane right now, considering everything. Considering the fact that if you add up every other Chinese EV maker, that they can't even come close to making what Tesla. If you add up all the profitable ones, they don't make as much as Tesla makes per car. BYD makes like less than $1,500 a vehicle. That's after heavy government subsidies. And then you look at legacy in the United States and it's worse. And now these guys are dialing back from EVs. And they're going back to hybrids that have no batteries. You know what all this does? There's 500 EV companies in China. It makes it to where all these companies are failing or walking away. It gives companies like Tesla some of the cheapest battery and lithium pricing they could possibly ever imagine. And it's an area of their margins that people are not paying enough attention to. So I totally agree with Couch Investor Neil. That's an area that's going to be super exciting in the future.
I agree. Oil coming down a little bit, down 0.5% on the day. The 10-year currently is at 4.65. I think that's up a little bit because, Jesse, can you speak to that unemployment data we got this morning? Or employment?
Oh, yeah. The employment costs. Yeah, I can. I've got it on my screen here. I could talk to it. And there's a few things that have come in since. But essentially, it's quarter over quarter, and it came in stronger. Oh, my God. I hate the Sprite view. Sorry. I'm like a vampire. Got to go back. Okay. So it's quarter over quarter. So a lot of these bad numbers, basically they came in hot. Employment costs for benefits, wages, and just the overall index came in hot. But we know from other employment data that came out recently this week that that's front loaded into January and February. So that's really the big stuff. So that's not too big of a deal. Redbook came in and that's retail sales. It's like a survey of the top retailers. That came in better than expected. So retail sales are okay. We're hot on these other things, but again, they're more like January and February data. March could be lower. And then the Case-Shiller, the home price details, they're going up. So home price year over year was 7.3%. It was forecast at 7. It was consensus at 6.7. So home prices, again, the existing home market used to make up like 80% of sales, 75% of sales. Now it's frozen. And so new home builders are making tons of money. The prices are going to keep going up until we unfreeze the market. And it's another reason why the Fed has to lower rates. But that's all the economic data from today.
Okay, that's fair. And yeah, that's why we're seeing a little bit of a decline in the broader markets. McDonald's beat earnings. So McDonald's right here, they beat revenue by 7%, beat EPS by 6%. Coca-Cola beat revenue by 9%, beat EPS by 11%. And Eli Lilly beat EPS by 5%, missed revenue by 1%. So, I mean, companies are still hitting their numbers. Neil, what are your thoughts on earnings season so far? I think we have another about 3 weeks left, but so far, so good.
Yeah, exactly. So far, so good. I mean, the big companies are doing quite well. We saw that last week. Tonight we have Amazon, Thursday Apple. So, I mean, for Amazon, I expect another great quarter. This giant is just becoming more and more profitable. With Apple, it's going to be interesting. We know there is weakness. Then now let's see if Tim Cook will have some positive comments with regards to the next wave of AI products for Apple, which I do think he's going to mention some parts of it during the call. But yeah, so far so good. I mean, McDonald's said they're going to test out a larger burger later this year. So this is a reverse shrinkflation. But no, overall, I mean, are we surprised that all of these big tech companies are doing well? I mean, with all the AI investments and stuff like that, layoffs. I'm not that surprised. But from a consumer side of things, we still have some companies that will report earnings in the coming days and weeks that should provide us with a bit more information. But so far, yeah, like you said, so far so good.
Jesse, I'm sharing your screen if you want to show anything here.
Oh, yeah, sorry. I was looking at the Japanese yen. I agree with everything Neil just said. He's spot on. If anything, I have a little bit of concern about Apple. I have concern. I'm probably going to do a Starbucks earnings call this afternoon. I just want to see how bad Starbucks is getting fucked in China. They have like over 3,000 locations, and they've grown their international exposure quite a bit. So I want to figure out, like, I'll have to touch base with Couch to talk about Amazon, or I don't know if either one of you guys are doing the earnings call. I'm very curious how that goes. But I also want to know how Starbucks goes. And this is the Japanese yen. So this is showing a very scary thing. I think it's going to be fine.
No? Yeah.
I think the Treasury is going to take care of it. But
what does this mean? What does this chart mean for 3-year-olds that you're showing?
Oh, okay. So this is the US dollar versus the Japanese yen. And so currencies trade against each other, right? That's how we figure out their value. And it's at the Japanese yen is at the weakest level it's been at since 1990, and it's getting ready to go to levels since 1986, which is about when Stranger Things, the TV show, is shown. So it's not great. It's not great for Japan. It's showing that their dollar or their currency is getting them nothing anymore. But I think that Janet Yellen is going to try and work things out to where they don't dump our treasuries. They're the number one holder of U.S. treasuries. If they started dumping them, yields would skyrocket for the bonds. And just a simple thing to say is when bond yields go up a lot, people sell their stock and they buy bonds because they can get a good return from them. And so it's basically like, oh, I could get 5, 6, maybe 7% returns on a bond in the future. Why would I go ahead and invest in the stock market when those are pretty good returns? So we don't want bonds to go up. We don't want the Japanese yen to get weaker. And so it won't, I don't think. I don't think Papa Powell's going to let it. I don't think Janet Yellen's going to let it. And I think that's going to mean that we're going to see maybe a dovish Papa Powell tomorrow.
It's a great time to go to Japan, by the way. Great time, cheap
No
for
kidding.
all of us.
Yeah. Super
All right,
cheap.
we got PayPal here struggling to maintain its green. I wouldn't be surprised if it goes red, and that's again largely due to the macro, not really the call. But for longs, the call is good, and hopefully Papa Pal is not horrible tomorrow. We can see a rebound. All right, I think that's pretty much it for us. Thank you everybody for being here. I'm going to put all of our YouTubes in the chat. So I know everyone's here on different streams, but still, please make sure you're subscribed to Jesse, Micro to Macro, on YouTube. That is highlighted. And Neil, Couch Investor, on YouTube. Any last words, Jesse and Neil?
No, go ahead, Neil. What do you got?
No, good earnings report, good call. Markets are red. Overall, like we said, earnings season so far so good. Next week, Palantir, I think Robinhood as well should be exciting. But yeah, overall, think long term. Unless you've got options, then then figure that one out. But I'm sure Jesse might help you with that.
Yeah, and I was going to say real quick, so people were asking why options are down. If you have January 17th, 2025 calls and the stock is only up 1.5%, you're down 7.5% on the day. That's not insane. But if you look here, the January 16th, 2026, this is why I've been dialing into these, so that if I fuck up my January 2025 trade, I still make money. So January 2026 is the exact opposite of that, and up 9.52% on the day.
Right.
So it's the shorter dated stuff has greater risk, and the probability of getting to 140, my previous target, versus getting to 95 in January 2026 is just so much lower. Now, if PayPal really starts to take off, that'll go up a lot. If it doesn't, then the 2026 is where all the money's flowing. Just to answer that question.
Right. All right. This was awesome. Thank you, everybody. Earnings season is just beginning. Got a lot more companies to cover. And we'll see you guys on the next one.
Bye, guys. It was fun.
Bye, guys. Have a good one. Good night.
See ya.